Gold just did something it has not done since 1980. It repriced vertically in a single quarter while every major stock index, the dollar, and even Bitcoin all lost ground against it at the same time. Central banks bought more physical bullion in the last 18 months than in any comparable window since records started in 1950. Meanwhile, Bitcoin bled out against the metal by over 40% on the ratio. Nobody on financial television is connecting these two facts. They should be, because what those numbers describe is not a gold rally. It is the early stage of a generational capital rotation, the kind that has only happened 3 or 4 times in the last century. And every time it did, it reshaped who kept their wealth and who watched it evaporate. I'm going to show you exactly how it works, who is driving it, and what it means for your positioning over the next 5 to 10 years. Real quick, let me know in the comments where you are from and what you are holding right now. Gold, Bitcoin, equities, cash, whatever it is. I want to see how this community is spread out and how you are set up heading into this. Now, here is how I want to lay this out. We need to talk about the structural crack that is forcing money out of one asset class and into another. Then, toward the middle, I'm going to show you a single chart that basically tells the entire story in one image. And toward the end, I will walk through what this means for Bitcoin specifically, including a timing window most people are ignoring. Let me start with who is actually watching. If you are someone who buys a little gold or Bitcoin every month and plans to hold for years, this rotation is the macro weather system you need to understand because it determines whether you're paddling with the current or against it. You do not need to catch every wave. You need to know which direction the ocean is flowing. If you are a short-term trader using leverage or options, buckle up, because rotations like this are a meat grinder. The trend looks obvious in hindsight, but intraday, the whipsaws will wipe accounts. Both paths have real implications here, and I will flag them as we go. So, let me zoom way out for a second. For roughly 5 decades, the global economy operated on a very specific engine. You grow the economy by expanding debt, you service that debt by printing more currency, and the bulk of that liquidity floods into dollar-denominated financial assets, mainly American equities. That is why the S&P 500 crushed almost every alternative for 40 years straight. The tide was rising, and stocks were the biggest boat in the harbor. But here's the part that changes everything. That engine is now choking on its own exhaust. United States federal debt just crossed $36 trillion. That is north of 120% of GDP, a level the country has not breached outside of World War II. The Congressional Budget Office projects that net interest costs will soon rival or exceed the entire defense budget if current policies continue. Let me say that differently. The U.S. government will soon spend more money just paying interest on old borrowing than it spends on the entire military. That is not a political opinion. That is arithmetic. And it is not just America. Global sovereign debt has ballooned past $100 trillion for the first time ever, according to the Institute of International Finance. Japan is sitting at over 260% debt to GDP, the highest of any developed economy on the planet. France just got downgraded by Moody's. The United Kingdom is running deficits that would have been unthinkable a decade ago. The whole architecture of borrow, spend, grow, repeat is hitting a wall, and the wall is math. Most people think this is a temporary budget problem that some clever policy can fix. In reality, it is a structural endpoint. When your debt grows faster than your economy for long enough, the only exits are inflate it away, default on it, or restructure the entire system. There is no door number 4. And when that reality starts bleeding into capital markets, money does something very specific. It starts hunting for the safest neutral asset it can find. Neutral meaning it does not live inside any single government's balance sheet. It cannot be printed, sanctioned, or frozen. And for literally thousands of years, that asset has been gold. Now, here is where the story splits into 2 completely different realities. On the screen, on the Bloomberg terminal, on the futures charts, you see a gold price that moves in dollars. That is the paper reality. It is priced by contracts, most of which never get delivered. On any given day, the notional volume of gold traded on COMEX and the London bullion market can exceed the entire annual mine supply of the planet. We are talking roughly 3,500 tons of new gold mined each year, and some estimates put daily paper turnover at multiples of that figure. That is not a market discovering the fair value of a scarce metal. That is a derivatives casino pricing its own abstraction. The physical reality is telling a completely different story. Central banks are draining vaults. The People's Bank of China has publicly added gold for 18 consecutive months, and those are just the purchases they disclose. Several analysts, including those at the World Gold Council, believe actual accumulation is significantly higher, routed through state-owned commercial banks to avoid headline risk. The Reserve Bank of India has been quietly buying every dip. Poland doubled its gold reserves in under 3 years, going from roughly 130 tons to over 400. Even the Czech National Bank, in a country with a GDP smaller than many American states, ran one of the most aggressive gold buying streaks in Europe. Physical premiums in Shanghai over London have stayed elevated for months, sometimes gapping above $40 an ounce. That premium is not decoration. It is a real price signal. It means Asian buyers are willing to overpay versus the paper benchmark just to secure actual metal in hand. One of these realities is fabricated, and it is not the one where actual gold bars are being loaded onto cargo planes and shipped to sovereign vaults. The paper price and the physical demand cannot both be telling the truth forever. At some point, one breaks toward the other, and right now, the physical side is winning. Let me connect this to the macro layer, because the structural force behind this is bigger than any single commodity. The headline narrative from most financial media is that inflation is cooling. The Fed might cut rates soon, and everything is basically fine. The problem is that the math behind that story has a hole in it the size of a freight train. Even if the Fed cuts rates, the deficit spending trajectory means the Treasury still has to issue trillions in new debt every year. Somebody has to buy that debt. Foreign central banks, the traditional buyers, have been net sellers of U.S. Treasuries for years now. China has reduced its Treasury holdings by over $150 billion since 2022. Japan has been liquidating to defend the yen. So who picks up the slack? Either the Fed steps back in and buys it, which is just money printing with a fancier name, or rates stay high enough to attract private buyers, which crushes the real economy. There is no clean path. Both roads lead back to gold, because both roads degrade the purchasing power of the currency the debt is denominated in. And here is the antagonist in this story, stated plainly. The institutions that run the paper gold and paper Bitcoin markets, the exchanges, the large commercial banks with outsized short positions, the ETF custodians, they benefit from the continuation of paper dominance because that is where fees, leverage, and control live. They do not need the real asset to move freely. They need volume on synthetic instruments. And you, the individual, risk confusing the paper price with reality, which means you either sell your real holdings at manufactured lows or you never buy at all because the screen says the opportunity already passed. Here is the piece that reframes everything we just covered. I came across an analytical framework that tracks what researchers call capital rotation evidence. What it does is simple but powerful. It takes every major financial index, the S&P 500, the NASDAQ, the dollar index, the Russell 2000, even M2 money supply and CPI, and it measures each one relative to gold. Not in absolute terms, in ratio terms. And right now, every single one of those metrics is in a bear market against gold. All of them, at the same time. That has only happened a handful of times in the last century. And every single time it did, it marked the opening of a multi-year rotation out of financial assets and into hard assets. During the early 1930s, the stock market collapsed, the dollar wobbled, and Roosevelt signed Executive Order 6102, confiscating private gold and then revaluing it from $20.67 to $35 an ounce overnight. A 69% forced devaluation of the dollar against gold in a single move, the Dow did not reclaim its 1929 high until 1954. That is 25 years of dead money in equities. In the 1970s, Nixon severed the dollar's last link to gold in August of 1971. Inflation spiraled. Gold surged from $35 an ounce to over $850 by January of 1980. More than a 2,000% move in under a decade. The Dow, adjusted for inflation, went absolutely nowhere during that stretch. After the dot-com bust in 2001, gold climbed from the mid-200s all the way above 1900 by 2011. Nearly an eightfold return. Commodities broadly entered what strategists call a supercycle, and equities spent years just crawling back to break even. Each of those episodes lasted between 5 and 12 years. And in every case, the investors who recognized the rotation early and repositioned were the ones who preserved and grew real purchasing power. The ones who stayed fully committed to stocks and paper assets lost a decade or more of real returns, even when nominal prices eventually recovered. So if the macrogravity says hard assets should be winning and gold is clearly winning, then why is Bitcoin losing ground? Is the thesis dead? Not necessarily. But we need to be honest about what is happening under the hood. Bitcoin was born during the expansion phase of this debt cycle. Every year of its existence until recently was characterized by falling interest rates, expanding central bank balance sheets, and risk appetite flooding into speculative assets. That was the rising tide that lifted Bitcoin from pennies to six figures. But Bitcoin in 2025 is a fundamentally different creature than it was in 2015. BlackRock alone now holds north of $50 billion worth through its iShares ETF. The asset is used as loan collateral across multiple prime brokerages. MicroStrategy has built an entire corporate treasury strategy on leveraged Bitcoin accumulation, borrowing billions against future appreciation. Miners finance their operations by pledging unmined reserves. The asset that was supposed to trade purely on scarcity is now wrapped in layers of paper products. And in the short term, those paper layers dominate the price. Sound familiar? It should. Gold went through the exact same securitization process starting in 2004 when the first gold ETF launched on the New York Stock Exchange. Paper gold suppressed the physical price for years, but eventually the rubber band snapped, and physical reality reasserted itself violently to the upside. Here's the technical picture, and this part matters whether you trade weekly or just want to understand where the cycle sits. Bitcoin has historically followed a remarkably consistent 4-year rhythm. The peak arrives roughly in the fourth quarter of the year after the halving. 2013 cycle topped in November, 2017 topped in December, 2021 topped in November. From those peaks, the drawdown phase has lasted almost exactly 1 year each time. The 2017 peak to the 2018 low took 364 days. The 2021 peak to the 2022 low took 371 days. And the climb from major cycle low to the next peak has taken between roughly 1,400 and 1,600 days each cycle. This time around, we peaked near $126,000. The critical support was the 50-week moving average, sitting around 102 to 103,000. That level is essentially the rolling average price over the last year of trading. Once price closed below it for several consecutive weeks, every prior cycle says the same thing. The bull phase is over. And once that 50-week average breaks, price gravitationally compresses toward the 200-week moving average. That number represents about 4 years of price history, and it has acted as the long-term floor in every cycle. Right now, it sits around 58,000. Factor in that each cycle's drawdown has been shallower than the last. Assume a roughly 70% decline from peak, and you land near 37 to 38,000. Align that with the 1-year drawdown timeline and the potential cycle low window falls somewhere between May and October of this year. I want to be clear. None of this is written in stone. External shocks accelerate timelines. Policy surprises delay them. But the pattern exists across 4 complete cycles, and dismissing it because you want a different outcome is hope, not a strategy. So the bearish path first. If this capital rotation accelerates, if foreign central banks keep dumping treasuries and stacking gold, if the deficit spiral forces the Fed back into some disguised form of money creation, then gold continues its repricing higher in financial assets, including Bitcoin stay under structural pressure. In that world, Bitcoin could test the 200-week average and potentially overshoot into the high 30s or low 40s. Equities could enter a prolonged sideways grind where nominal prices might look fine on a screen, but real inflation, adjusted returns, stay negative for years. For long-term holders, that means your entry price and cost averaging discipline matter enormously. For leveraged traders, every counter rally becomes a trap engineered to liquidate late shorts before the downtrend resumes. Now the bullish path. If inflation data genuinely rolls over, if the Fed manages to cut rates without reigniting price pressure, and if geopolitical tensions de-escalate enough to restore global appetite for risk, then Bitcoin could stabilize near its 200-week average and begin building the base for the next cycle. Gold might consolidate after its vertical run, but hold its gains because the central bank buying is structural, not speculative. In that scenario, both assets rise, just with gold leading on the ratio for several more years. For long-term holders, that is the quiet accumulation zone where patience gets rewarded. For traders, the bottoming process will still be ugly, full of false breakouts and failed rallies that make both bulls and bears look foolish in alternating weeks. The lesson from prior cycles is simple. Bear markets humble everyone eventually. So where does this leave us? 3 things to carry with you. Number 1, every major financial metric is currently losing ground to gold simultaneously. That pattern has preceded every significant capital rotation event of the last century. The signal is loud, and it is not ambiguous. Number 2, Bitcoin's short-term price is now dominated by the same paper derivative machinery that suppressed gold for years before it broke out. Scarcity wins in the long run. Leverage and synthetic instruments set the price in the short run. Understanding that gap is the difference between conviction and confusion. Number 3, the drawdown timing from prior cycles points to a potential bottom window in the second half of this year. That does not mean it will happen on schedule. It means you should have a plan ready for what you do if it does, and a plan for what you do if it does not. The unresolved question hanging over all of this, and it is the one I keep circling back to, is whether physical reality finally overwhelms the paper machinery or whether the system finds one more trick to extend and pretend. Because that answer does not just set the price of gold or Bitcoin. It determines the architecture of the entire monetary order for the next generation. And nobody, not me, not any central bank governor, not any fund manager on television, knows the answer yet. What I do know is this. Volatility during a rotation like this is not your enemy if you understand the current. It only destroys you if you are over-leveraged, underinformed, and reacting to headlines instead of structure. So do your own homework. Build a portfolio that survives multiple outcomes, not just your favorite one. And do not let anyone, myself included, tell you what to do with your money. This is not financial advice. It is a map. Where you walk on it is entirely your decision. Tell me in the comments whether you think this rotation has legs or whether risk assets bounce back hard before the year is out. I want to hear the pushback as much as the agreement. And if this was the kind of breakdown you find useful, let me know by subscribing. I will be back soon with more.